Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Elliott Wave Theory Explained, a practical guide for traders and investors. Predicting market trends can feel like solving a puzzle, but Elliott Wave Theory offers traders a unique perspective. Developed by Ralph Nelson Elliott in the 1930s, this method breaks market movements into repeatable patterns, or waves. These wave patterns reflect crowd behavior, helping investors anticipate price moves with greater confidence. Whether you're new to trading or looking to sharpen your strategy, understanding this theory can give you an edge in today's fast-moving financial markets. What is Elliott Wave Theory? Elliott Wave Theory is a method for analyzing financial markets by identifying patterns in price movements. At its core, it's based on the idea that market trends unfold in repetitive waves that reflect human psychology. Traders and investors use these patterns to forecast potential price changes, making it a valuable tool for decision-making. Now, let's dive deeper into its origins and main principles. The origin and history. Elliott Wave Theory was introduced by Ralph Nelson Elliott in the 1930s. Elliott, an accountant by trade, became fascinated with the stock market after health issues forced him into early retirement. He spent countless hours studying historical market data, eventually spotting distinct, recurring patterns in price movements. His work culminated in the publication of the wave principle in 1938. Elliott proposed that markets move in predictable cycles driven by collective investor psychology. These cycles take the form of alternating waves, 5 in the direction of the main trend and 3 in a corrective phase. Back then, this was revolutionary, offering a methodical way to understand what often seemed like chaotic market behavior. Elliott called his patterns waves because they ebbed and flowed like ocean tides, capturing the natural rhythm of market activity. His ideas gained wider recognition when famous financial analyst A.J. Frost and trader Robert Prechter popularized them in the 1970s, transforming the theory into a cornerstone of technical analysis. Core principles of Elliott Wave Theory. At its foundation, Elliott Wave Theory revolves around a few key principles. Markets move in waves. Price movements aren't random, they follow identifiable waves. These waves fit into 2 categories: impulse waves, 5 waves. These follow the direction of the main trend. Corrective waves, 3 waves. These move against the trend, representing a pullback or consolidation. Mass psychology drives price action. Elliott's theory is rooted in human behavior. Crowds of traders tend to act in predictable ways during periods of optimism or fear. These emotional cycles are what create the repeating wave patterns. Fractals and repetition. Waves repeat themselves on multiple timeframes. This means you'll see the same 5-wave, 3-wave structure whether you're looking at a 1-minute chart or a monthly chart. It's a bit like zooming in on a snowflake and finding the same shape in its smallest details. Fibonacci relationships. The size and timing of waves often follow Fibonacci ratios, like 1.618 or 0.618. This connection to natural mathematics adds another layer of precision to the theory. These principles make Elliott Wave Theory unique. By focusing on the psychological aspect of trading, it shifts the perspective from numbers and charts to how people think and react. Structure of Elliott Waves. Elliott Wave Theory breaks market movements into distinct patterns that reveal the psychology of buyers and sellers. Understanding the underlying structure is key to using the theory effectively. Each wave plays a role in illustrating the market's current trend and potential future direction. Below, we'll look at the core building blocks of these patterns and how they are identified. Impulse waves versus corrective waves. At the heart of Elliott Wave Theory are 2 primary wave types: impulse waves and corrective waves. Each serves a specific purpose in market analysis. Impulse waves. Impulse waves are the driving force of a trend. They consist of 5 smaller waves that push the price in the direction of the main trend. Picture these as the market's forward momentum. It's like a car accelerating on an open highway. The 5 waves of an impulse include 3 upward movements, labeled 1, 3, and 5, and 2 pullbacks, labeled 2 and 4. Characteristics of impulse waves: always move with the underlying trend. Structured with clear subdivisions into smaller waves. Wave 3 is typically the strongest and longest. Corrective waves. Corrective waves, on the other hand, represent short-term counter-trend moves. They are made up of 3 smaller waves, labeled A, B, and C, and indicate a pause or retracement within the dominant trend. Think of these as rest stops along the road. They're temporary and don't change the bigger picture. Features of corrective waves: move against the prevailing trend, tend to be choppier and more unpredictable, lack the strength and clarity of impulse waves. Knowing how these 2 wave types interplay helps traders recognize where the market is headed and when it might pause or reverse. The 5-3 wave pattern. Every Elliott wave cycle combines 2 distinct phases, a 5-wave impulse phase followed by a 3-wave corrective phase. Together, this creates the classic 5-3 structure. Breaking down 5-wave impulse pattern. The impulse phase contains 5 waves. Wave 1. The market begins to rise as early investors buy in. Wave 2. A short pullback occurs as traders take profits. Wave 3. Strongest wave. Momentum builds as more participants join the trend. Wave 4. Another pullback, but less dramatic than Wave 2. Wave 5. Final push upward as enthusiasm peaks. Understanding the 3-wave corrective pattern. Once the impulse phase ends, a corrective phase unfolds in the opposite direction. Wave A. Initial counter-trend move as the market reverses. Wave B. A brief retracement of Wave A, giving the illusion the trend is back. Wave C. Final move downward, completing the correction. For example, if a stock rallies from $50 to $100 in 5 waves, a correction might follow, dropping the price back to $75 in 3 waves. This predictable rhythm makes the theory so powerful in forecasting. Fractal nature of Elliott waves. One of the most fascinating aspects of Elliott waves is their fractal nature. Fractals are patterns that repeat at different scales, much like how tree branches resemble smaller versions of the whole tree. Elliott waves behave similarly. Smaller waves within larger waves. Each individual wave can be broken down into smaller waves of the same structure. For example, a single impulse wave on a daily chart may contain 5 smaller waves when viewed on an hourly chart. Waves across timeframes. These patterns appear on any time frame, whether you're analyzing a 1-minute chart or a yearly market cycle. This fractal quality allows traders to zoom in or out of their charts and still work within the same framework. It's like having a roadmap that works whether you're navigating a city or the entire country. How to identify wave degrees. Elliott categorized waves into degrees to help traders understand trends at different scales. These degrees span from the longest cycles, lasting decades, to the smallest intraday moves. Knowing wave degrees helps you contextualize market activity within a broader timeline. Here are the key wave degrees in ascending order. Grand supercycle, the largest degree, spanning decades or even centuries. Supercycle, lasts several years to decades. Cycle, covers 1 year to a few years. Primary, typically lasts a few months to a year. Intermediate, lasts weeks to months. Minor, minute, minuet, and sub-minuet. These smaller degrees focus on weeks, days, or even hours. Think of wave degrees as a multi-layered map. The grand supercycle represents the entire globe, while the sub-minuet zooms into a single neighborhood. Recognizing the right degree can make or break your strategy. For instance, if you misinterpret a correction on an intermediate level as a primary trend reversal, you might make the wrong move. When identifying degrees, pay attention to the scale of the price movement and its position within the larger trend. Seasoned traders often mark degrees on their charts to stay organized and better track the market's rhythm. Understanding wave degrees adds depth to your analysis, enabling you to fine-tune your trading plans. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.